This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Chapter 13, Real Options. Now let me explain first of all what we mean by real option, and then we'll look at the arithmetic that could be involved. But what it is, it relates to ordinary project appraisal. Normally, if we're presented with a project to appraise, we set up the cash flows, we discount at the cost of capital, and we calculate the net present value. And if the net present value is positive, it's worthwhile, and the higher the net present value, the better. But and that is the value of the project to us. The value of the project is the net present value. And we've revised net present values in an earlier chapter. However, usually when we're looking at projects, we regard them as being what you might call take it or leave it, or all or nothing. We either do the project, get the NPV, or we don't do the project. But what's quite likely in real life is that we have a project available, but built into it there could be various options available. They're listed on page 69, but for instance there could be an option to delay it. That instead of it being either accept or reject, it could be that there was the possibility, if we needed, of delaying the project. And surely that would make the project more attractive to us. It would make it more valuable. That we could either start now or we could start in a few years' time if things look bad now and better later. Or perhaps more obviously, the fourth one on page 69, an option to redeploy. That we might be considering a project to do something, but clearly all the cash flows we use are estimates, and maybe if partway through the project we realise things were going badly, maybe we have the choice to either stop the project completely, to abandon it, or we'd have the option to switch and devote the resources to a different project that we're allowed to change things. Well, if there are possibilities like that available to us, that again, instead of it being here's the project, do it or don't do it, full stop, if there are those possibilities that we could change things, delay, expand, abandon, redeploy, and then we say we've got real options, and having those options available to us again makes the project more valuable. So that's what a real option is. A real option, it's simply the possibility of effectively changing the project. Possibility of changing the project. And so, as I say, if those sorts of possibilities exist, they make the project more valuable to us. And for the exam, be clear what we mean by real options, be able to explain and make sure you've read page 69 properly. But he could also ask you to value the project and to work out the benefit to us of the option. And have a look at example 1 with me on page 70, which hopefully will make even more clear what we mean by a real option and the arithmetic that could be involved. So example 1, Warsaw plc is considering a new project which requires an outlay of 10 million and has an expected net present value of 2 million. So that will have been calculated doing normal calculations. We've listed the expected cash flows, we've discounted the cost of capital, the expected net present value is 2 million. And so does that not mean that we've got the initial investment obviously of 10 million, If we've got an expected net present value of 2 million, it means the present value of the receipts from the project are 12 million. And that's how we've ended up with a net present value of 2 million. So that's the normal position. And although we didn't have to do the discounting here, we've checked it earlier, and for that bit there'd be nothing new. However, it says that the economic climate over the next few years is thought to be very risky, and the volatility attaching to the net present value is 20%. Now, he'd have to give you that in the exam, but effectively it's a standard deviation of the future cash flows. And we're able, if we want, to delay commencing the project for 3 years. So there's our option, that instead of investing now, if we want, we can delay it for those 3 years. And there's a risk-free interest rate of 6% per annum. Well, this is effectively, is it not, a call option. We can either spend money now and get an expected 12 million, or we can wait 3 years, again, to get that expected 12 million. Well, as it is effectively a call option, we can use the Black-Scholes formula that we looked at in the previous chapter. We can use the formula to place a value on that option to delay. And in the Black-Scholes formula, the value of a call option was PA ND1 minus PE ND2 e to the minus RT. And we're going to use exactly the same formula as we did last time. It's simply a question of deciding what numbers we're going to use for the symbols. We know what D1, D2 are. You've got the formula on the formula sheet. We've practiced using them. But let's decide what values we'll place on each of them. First of all, PA is the current value of the project, the current present value of the project, which we've just seen, its value is 12 million. PE is effectively the exercise price. Well, our exercise price, we're thinking of waiting 3 years, but the exercise price would be the investment, the capital expenditure. Which is 10 million. So we're going to invest 10 million to get an expected 12 million. But of course, in 3 years' time, the value of the project, it may be higher, it may still be 12, it may be higher, it may be lower. T, the time to expiry, well, is 3 years. It's in 3 years' time that we're able to invest. The risk-free rate is 6% or 0.06. The standard deviation, again, we're given, is 20% or 0.2. So let's put those values in the formula and work out the value of the option. Remember, for the formula we need D1 and D2. So D1, first of all, D1 is ln PA over PE plus R 0.5s squared times T divided by S root T, which is what? ln PA, the present value of the project is 12 million. PE, effectively the exercise price, is 10 million. Plus R 0.06 plus 0.5 times S.2 squared times T it's 3 years to expiry, divided by s.2, the square root of 3, which gives us the log of 12 over 10 is plus 0.1823. The second term, if I start from the end, 0.2 squared times 0.5 plus 0.06 times 3 is 0.24, divided by 0.3, sorry, I beg your pardon, 3 square root times 0.2 is 0.3464. So I get D1 to be 0.1823 plus 0.24 divided by 0.3464. I get 1.2191. D2 is D1 minus S root T. D1 1.2191 minus S is 0.2 times root 3, which comes to 0.8727. There's D1, D2. We need n of D1 and D2, so use the normal distribution. ND1 is n of 1.21. It's positive here, 1.22, sorry. And so it'll be 0.5 plus the table figure. And the table figure, 1.2 down the side, 0.02 along the top, is 0.3888. So ND1 is 0.888. ND2 is n of plus 0.88. Again positive, so 0.5 plus table figure, and 0.88. 0.88 is 0.3106. Now we can stick it in the full formula. The value of the call option, PA ND1 minus PE ND2 e to the minus RT is what? PA, what did we say it was? The value of the project, which is 12 million, times ND1. PE, the exercise price, the amount to invest is 10 million. ND2 e to the minus R times T. I can do this in my head, surely. R is 0.06, T is 3, so R times T is 0.18, which gives us 12 times 0.8888 is 10.67. The second term, again, as always, I'll do the E bit first, so 0.18 negative e to the power, that gives 0.835. If I multiply by 0.8106 and by 10, I get 6.77, which gives me 3.9 million. These were in millions, remember. Now, what that is the value of the call option, of the option to delay, which means that the full value of the project to us remember, if we were forced to do it now, then on expected figures, we had an NPV of 2 million. So the project was worth 2 million anyway. The option to delay makes it more beneficial here an extra 3.92 million, it gives a full value of 5.92. So there's the value of the project, and it's that of course we could compare